Welcome to the world of options trading. If you're looking to level up your investing skills and take on the challenge of options trading, you've come to the right place. In this tutorial, we'll break down everything you need to know about trading options, step by step. By the end of this video, you'll have a solid understanding of how options work and how you can start trading like a pro. So, don't forget to hit the like button, share this video, and subscribe to my channel for more insightful content on trading and investment strategies. What are options? An option is a contract that gives one party the right, but not the obligation, to buy or sell an asset at a predetermined price within a set time frame. Unlike owning the asset, options allow you to speculate on its price movement, offering both opportunities and risks. For example, if you're unsure whether phone prices will rise or fall in 3 months, you pay a small fee for the right to buy the phone at today's price later. If prices rise, you benefit from the old price. If they fall, you only lose the fee. This is similar to how options work. In options trading, if you believe Tesla's stock will rise, you can buy a call option. This gives you the right to buy Tesla stock at a fixed price, and if the stock rises above that price, you profit. If it doesn't, you lose only the premium paid. To visualize this, a graph would show the stock price on the x-axis and the option's value on the y-axis. As the stock price rises above the strike price, the option becomes more valuable, showing potential profits. If the stock price doesn't rise, the option's value decreases, but your loss is limited to the premium you paid. Types of options: call and put. There are two main types of options: call options and the put options. Call option. A call option gives the buyer the right to buy an underlying asset at a set price within a specific time frame. If you believe the asset's price will go up, you can buy a call option. If the price goes up, you can exercise the option and buy the asset at the lower price, making a profit. Put option. A put option gives the buyer the right to sell an asset at a predetermined price. If you believe the asset's price will go down, you can buy a put option. If the price drops, you can sell the asset at the higher strike price, profiting from the difference. A simple example to understand options. Let's break it down further with a simple example. Imagine you're a bull, someone who believes the price of an asset will rise. On Tesla's stock, you enter into a contract with a bear, someone who believes the price of the stock will fall. In this case, the bull buys a call option, giving him the right to buy Tesla's stock at $165 in 3 months. If, after 3 months, the stock price rises to $190, the bullish trader can exercise his call option and buy Tesla at $165. He can then sell the stock immediately at $190, making a profit of $25 per share. But if the stock price falls to $140 instead, the trader does not have to exercise the option. He simply lets it expire and loses only the premium he paid for the option, let's say $10 per share. In this example, the bullish trader is called the option buyer, while the bearish trader is the option seller. The option buyer has the right, but not the obligation to exercise the option. On the other hand, the option seller has the obligation to sell the asset at the agreed upon price if the buyer chooses to exercise the option. What is an option? Premium. When buying an option, the buyer pays a premium to the seller for the right to exercise the option. The premium is essentially the price of the option contract. It is a non-refundable amount that the seller receives when the contract is entered. In our example, if the buyer paid $10 as the premium for the call option, the seller of the option, the bear, would keep the $10 premium. If the stock price rises above the strike price, the option buyer makes a profit and the seller incurs a loss. But the seller's loss is partially offset by the premium they received. Understanding moneyness. Moneyness refers to how much an option is in the money or out of the money. It is an important concept when evaluating options. In the money, ITM at a break. A call option is in the money if the stock price is above the strike price. A put option is in the money if the stock price is below the strike price. Out of the money, OTM. A call option is out of the money if the stock price is below the strike price. A put option is out of the money if the stock price is above the strike price. At the money, ATM. An option is at the money when the strike price is exactly the same as the current price of the underlying asset. Key factors that affect option premiums. The price of an option premium is influenced by several factors: intrinsic value, moneyness. If the option is already profitable, in the money, it has intrinsic value. The more in the money an option is, the higher its premium. Time value. The more time left before an option expires, the higher the premium. This is because there's more time for the underlying asset's price to move in favor of the option buyer. Implied volatility. Higher volatility leads to higher premiums because the possibility of big price swings increases. If the underlying asset is highly volatile, the premium will be higher. Risk and reward in options trading. Options trading is a high-risk, high-reward activity. As an option buyer, your potential loss is limited to the premium paid for the option, but the potential profit can be unlimited. The key to becoming a pro at options trading is managing risk and understanding the leverage that options offer. The option seller, on the other hand, faces unlimited risk because they must sell the asset at the strike price if the buyer exercises the option. Their reward is limited to the premium they receive when selling the option. How to trade options profitably. To trade options like a pro, you need to develop a strategy and understand the factors that affect the price of the underlying asset. Here are some common approaches. Breakout trading. If you're following a breakout strategy, you'd wait for the price of a stock to break above a resistance level or below a support level. Once the breakout happens, you can buy a call option if bullish or a put option if bearish. Trend following. This strategy involves identifying a strong trend and trading options in the direction of that trend. If the stock is trending up, you can buy call options. And if it's trending down, you can buy put options. Straddle or strangle. These strategies involve buying both call and put options on the same asset, betting that the price will make a large move, but not knowing in which direction. You make money if the asset's price moves significantly in either direction. The importance of monitoring the market. Successful options trading requires constant monitoring of the market. Prices of options can change quickly based on market conditions, news, or earnings reports. Keeping an eye on these factors will help you make better decisions on when to buy or sell options. Option Greeks. As you progress in options trading, you'll encounter the concept of a Greeks. Greeks are a set of metrics that measure the sensitivity of an option's price to various factors, such as the price of the underlying asset, time to expiration, and volatility. Delta measures how much the option price will change with a $1 change in the underlying asset's price. Gamma measures the rate of change of delta. Theta measures how much the option's price will decrease with the passage of time. Time decay. Vega measures how much the option price will change with a 1% change in implied volatility. Understanding these factors can help you make more informed decisions when trading options. Risk management in options trading. The most successful options traders know that risk management is key to long-term success. Never risk more than a small percentage of your trading capital on any single trade. 2% is a common recommendation. This way, if a trade goes against you, your losses will be limited. Also, use stop-loss orders to limit your losses if the market moves against you. Protecting your capital should always be your top priority in options trading. Options trading can seem complex at first, but with the right knowledge and strategies, you can master it and potentially profit from it. By understanding the basics, like call and put options, option premiums, and the factors that affect them, you'll be well on your way to becoming a pro at options trading. Remember, practice is key. Start small, develop a solid trading strategy, and manage your risk carefully. With time, You'll gain the experience needed to make informed decisions and trade options profitably. If you found this video helpful, don't forget to like, share, and subscribe to my channel for more trading tips and strategies. Happy trading, and I'll see you in the next video.